Good evening. I hope you're doing well. First of all, thank you very much for liking, commenting, and subscribing. In today's video, I would like to address some of the questions that have been asked by you on various social media channels. So, I'll directly start the Q&A session. In the first question, I will read out. This is coming from Harish Bisht, and the platform is LinkedIn. He says that he has seen my podcast on a digital blogger and would like to get a few missing pieces of the puzzle. Now, here I would just like to add that the questions that I have been asked, I have grouped them into categories, and in today's category, I would be addressing questions related to system building. And the idea is that I will address these individual questions that are coming from various people who will at their own unique level represent a particular demographic and be asking questions on their behalf. So with that idea in mind, here Harish is asking for more information on the system that I proposed, the hypothesis that I proposed in the podcast with a digital blogger, Asim Juneja. So he says that, like you said, if you enter the trade if ADX on the monthly is above 25. So here I would just like to add, so I will increase the font a little bit since I am addressing this question, and so that you get more clarity. Now here I would like to add that if ADX is above 25, what does it mean? It basically means that the security is trending. So we are just trying to confirm that the security is trending on the longer time frame. And I have addressed this in the previous video that if we are doing this on the monthly, then we are essentially looking at an aggressive investment plan into the direct stock market. This is where this system would be most effective. This system would not be so useful in futures simply because the future expiry will run out before the entire candle can play itself. So therefore, like you said, if ADX is above 25, here I would like to add the condition that ADX above 25 implies that the security is trending, but it leaves a little bit of subjectivity on the user to determine whether the trend is up or down. And ADX below 25 obviously indicates that the security is not yet trending. So that is outside the scope of a trend trader. The trend trader is going to look at ADX above 25, and here to have a definite confirmation that it is indeed trending, I would suggest you use the indicator called DMI. And here, if you apply the setting that I will just mention, that the positive DMI, all right, it must be greater than the ADX, which in turn must be greater than 25, which in turn must be greater than the negative DMI. Negative DI, sorry. All right, I'll just make this bold. All right, so the idea is that we want ADX above 25. Yes, definitely we want ADX above 25, but we also want that the positive DI should be higher than the ADX itself, which means not only is it trending, but it also has a very strong momentum, and that is further confirmed that any selling pressure is actually quite weak because it is the smallest value in this particular variable, and this ensures that we are looking at an uptrending security using the ADX DMI indicator. So I just thought I will add to that point. So now I think I have addressed the first bit in which he's asking, in which Harish is asking about the application of ADX to determine the trend, and since he has given the time frame as monthly, we are looking at it as investment in the direct stocks. Now, and the stochastic is 14. Stochastic 14 is a setting, so he has set it to 14. I personally feel that it is better if you use the setting of 5 because it takes approximately 5 weekly candles to create a month, right? And I mean, so maybe 5 or 4, so 4 or 5. All right, stochastic at 14 would be too slow, and it does not fit in this ratio. See, we are dropping from monthly to weekly, so which means that the ratio has to be consistent. If you were dropping directly from monthly to say daily, then it obviously has to be stochastic 22 or 25, however you see it for that month, you could change it, etc. But the ratio should be mentioned, should be consistent. So instead of stochastic 14, I think maybe perhaps you could consider using stochastic 4 or 5 for the reason that I have mentioned. And so he says that the stochastic is below 20, which means now here we are saying we have already established that the security is trending up on the monthly, and below below 20 on the weekly. It also further indicates that this particular security is actually oversold, right? This is what it is indicating, because the oscillator is actually now in oversold territory. So now we can be sure that this particular indicator has told us that the oscillator is oversold, so which is reasonable, and the daily forms a bullish engulfing pattern. So now here he's come to the actionable time frame, that is the time frame which is being used for the entry, and it has formed an engulfing pattern. So obviously we will wait for confirmation. We will wait for confirmation here, because it has formed the pattern, but is it confirmed? So this would be my remark on this particular point, that we should wait for confirmation. Will you most likely enter the trade and place your SL on the base of the daily chart? Okay, so I'll break this here first. So now the question is regarding the SL. Obviously the trader is seeing the bullish engulfing pattern, and let us assume the next day he or she also sees the confirmation of that particular pattern. Now the question is, where do I place the SL? Do I place it below below the low of the day? Should I place it below the low of perhaps the month, some say 6 months or 8 months or 10 months? Should I choose a number like that, or should I have a moving average, or should I wait for a bearish crossover on the ADX, etc.? So the question is, where will you place the daily is largely going to be determined by how accurate do you want the system. All right. So now what do I mean by this? How accurate do you want the system? Here basically sorry, I'm sorry. All right. So it's basically how accurate do you want. So I'll just all right. What does it basically mean? Now let us consider this scenario. So I will just erase this question for now. I think this question will in itself occupy quite a bit of time, and I can address the other question in another video. But now consider a scenario in which there is a stock, let us say Reliance, which is trading at, let us say, CMP of say 3000. I'm just giving this number. All right. And a trader has 3 choices. Okay. Choice number 1 is to buy. I mean, these are all long choices. The trader is bullish on Reliance. Buy at CMP with SL. Let's just give it a number, say 2850. All right. And target. Let us give it a number, say 3450. All right. Or the other option is to let us say, that is to buy at SL with buy at CMP with, let us say, SL at 2000, right? And obviously then the target in that case I mean should be close to really say 6000. All right. And the third choice would obviously be to buy with SL 0. All right. And obviously in this case the target would be close to 9000 or 10,000. All right. So now here we have these 3 cases. Okay. In the first case, the trader has taken a 150 point SL and a target of 450 points, which means that the trader is targeting a 3:1 reward risk kind of a setup. In the second case, the trader has taken a 1000 point SL and a similar 3000 point target. So once again a 3:1 is mentioned. And here now the trader is taking the full 3000 points as SL. So now the trader has to look for a 9000 point target, which would mean that once again to maintain this we have this setup. So you would notice that in these 3 scenarios all the traders are bullish, but in the first scenario the trader has a much shorter SL. In the second scenario the SL is slightly wide, and in the third scenario the SL is not there, which means the trader will not leave the position, and the only way the trader is going to exit this position is if Reliance eventually delists from the index. Now the question is, which is the best setup? All right. I mean, just mathematically speaking, we are not concerned about how we came to the conclusion of whether Reliance is bullish or not. I mean, we have addressed it here. So let us assume that this is met in the case of Reliance, and because it is met in the case of Reliance, we are at this stage, and but you could have other criteria also. I just mentioned one. So we are in the stage where we are planning a trade mathematically for Reliance. Now, what happens? You would notice in case number 3 is that if SL is equaling 0, right? Then the accuracy tends to being 100%. All right. So accuracy tends to being 100%. What does it mean? It means that because you are taking a bet that Reliance will not delist from the market, therefore your bet is most likely going to be accurate, right? Now, but what's the problem here? The problem here is that that the target of 12,000 on Reliance could actually be a very, very, very wide target. Which means mathematically, once the position on Reliance has been created, it could be an indefinite trade. It could be for maybe 5 years or 15 years, 25 years. It could be for years to decades kind of a trade. So which means that once you have taken a very wide SL, you have necessarily widened a time frame. All right. And once you have widened the time frame, essentially it means you are not going to be churning this particular security, all right, which is ideal for what an investor wants. All right, so you have a widened time frame, and now in that widened time frame, Reliance has to go and hit that target, right? So now we are taking a bet that in 5 to 15 years, Reliance would be valued at 12,000 because it is structurally trending up and it is giving us a fair entry because it is oversold, etc. But the bet has to be, but the only way we are going to make money, because the only way we are going to book is going to be when Reliance eventually hits the 12,000 figure. So which means that this trade could be open indefinitely, and obviously it means that if you are wrong, then it is possible that for 15 years Reliance is trading at say 6,700 rupees or 8,200 rupees, but and it never reaches 12,000, right? So essentially, even though you have the accuracy, your stop loss is not hit, but the trade is open and it is almost redundant, right? So it could be indefinite, widened time framed, indefinite holding period, no churn. There is no rotation of capital here. All right, and now let us compare it with the initial case. All right, here if SL is close, all right, if SL is close by, then accuracy is obviously going to be lower. Why? Because trader number 3 is taking a bet that Reliance is not going to get delisted, whereas trader number 1 is taking a bet that that Reliance will not correct by 5%. So clearly you can see that trader 1 is taking a far more aggressive bet here, and once this trader is taking a far more aggressive bet here, obviously to get the reward multiple of it, he just needs maybe say a 3x move on the bet size of Reliance, say 15% move on Reliance. So now this trader will have a lower accuracy but will have a shorter trade duration, or a more finite trade duration, is actually a finite trade duration, and there will be rotation of capital. But now the most important difference that will come between the two of them is the position sizing. All right, so for example, if trader number 1 has to risk, let us say let us just give it a number, say 3,000 rupees, then such a trader would buy 20 shares, right? Whereas trader number 3 would have to buy just 1 share, right? Now in 20 shares, now obviously both the traders are risking just 3,000 rupees, but in 20 shares, when the trader actually hits the target, which is I mean it is far more likely that this trader will hit the target. I mean, if Reliance has to reach 12,000, then certainly it has to cross 3,450. So and if Reliance has to reach 12,000 in say 2 decades, then certainly in a few weeks, months, maybe 6 months, a couple of quarters, it could hit that particular target without hitting the SL. So which means that this particular trader is actually creating this particular position for a change in income status, right? Because he or she is planning to book this trade preferably in the short term. 15% move from point of entry to a high is a very reasonable move to expect in a stock in a particular year. 15% up or down in a stock price for a period of say 6 months to 9 months is as good as considering it to be flat in most cases. You will obviously check it in ratios of ATR to Nifty ATR or whichever is the underlying index. But the idea is that this particular position is changing income status, whereas this particular position is more geared towards capital growth, right? because in both cases both the traders are earning pretty much the same amount. That this particular trader is earning 20 into 450, which is 9,000 rupees. Trader number 3 is also earning 9,000 rupees, but there is a huge probability that this trader will earn 9,000 rupees in say 4 weeks time, whereas trader number 3 will have to wait for decades to earn the same 9,000 rupees. And in exchange for a closer reward, the trader is taking a closer SL. So my point about hitting out on this is that neither of the three traders are wrong. Whether you take a 5% SL, whether you take a 30% SL, or whether you take a 100% SL, neither of the trader is wrong. You just have to ensure that your expectations are aligned with the stop loss that you're taking, and which eventually governs the position sizes that you're actually taking. So where I would keep the SL, if I mean for very long time, I wouldn't even I beg your pardon, for very long time I wouldn't even take the low of the bullish engulfing. So say for example, if a security has formed a bullish engulfing with the low at 100 and let us say closed at 107, the midpoint is say 103.5, I would perhaps have a SL at 102 or 101.85, some kind of a number like that. And the reason for that is that in the event a bullish engulfing has to fail and you keep the pivotal low as the SL, then it is almost the probability that it is going to gap down from that range is very, very high. Because when the bullish engulfing was formed, the market was very emotional at that particular level. It is possible that when the market reaches the same level, again, it will once again be quite emotional, and that emotion is going to very likely be manifested as a gap. And typically, if a security has already got into oversold conditions and there is a gap after a break of a technical pattern, it is usually a continuation gap. So it gives it huge downside targets, and it is fairly reasonable to expect that a 5%, 3%, 2% SL is totally going to go from that position. So in other words, trader number 1 who would have entered at the bullish engulfing candle is saying that Reliance is an uptrend and the bullish engulfing at this level is very likely to hold. So this trader is taking up a position based on a candlestick, whereas trader number 3 is saying Reliance is an uptrend, the bullish engulfing gives me a good value to enter, and from here I'm sure Reliance will not get delisted. So these two bets are so far apart, even though they both get categorized as longs only, that it is difficult to compare. It is difficult to compare them in isolation, and therefore in my previous videos I have suggested that you have to look at a few set of parameters in totality before making a conclusion whether a particular system is better than the other system, and using your own data points as a reference is the key to that particular matrix. So to answer that question, where would be my SL on the would it be on the low of the daily chart? The answer is no. It would be pretty much higher than the pivotal point. I would not wait for the test of the low, and the reason is because, as you are aware, I take single direction trades and I will not risk holding on to a security right at the low of the pivot, because if the gap is there, it is not going to let you exit, or the exit is going to be really bad. So and the whole day basically is a tough day. Actually, you are just a security has gapped out of your range, and yeah, I mean, because I have a lot of experience, so I have protocols developed for it. But even though I have protocols developed for it, it is not a comfortable experience that you buy a security at 3,000 with a planned SL of 2850. It comes all the way to 28, say 2900 or 2875, 2862, some level like that. And then the next day it decides to gap down and open at say 2685. Very tough decision very tough time to maneuver in the market, because once it's gapped, you're also hoping there's a reversal, etc. So a lot of questions come at that time. So yeah, that would be the answer to where would I base my SL. So I would say it depends on how accurate do you want the system, and then but where will you exit or profit take? What parameter do you exit? So my profit taking parameters earlier were technically driven, which means that if I saw, let us say, a flag pattern, then the target would be the target of the flag pattern. But obviously, because I did not, because that was the only information I had, and I tried to be as objective as I could, and I used it. But after several months, years elapsed, and I started reviewing my own data, I could identify that it is best if I take a target which is mathematically driven from my own system's output, rather than waiting for pattern targets from standard structures. So where would I take the target? The answer depends on what is the accuracy of my system. If my system has an accuracy of 50%, then my target would pretty much be 1:1. If my system has an accuracy of say 35%, then my target would be 2:1. Like I would go for a bigger target. If it is say 65%, then it would be maybe 1/2:1, or maybe lesser than that, because I have an accurate system, and I want to I'll use partial targets to keep the system profitable, which means the idea of taking partial targets is to keep your system just profitable. It should be floating, and that other half that is left behind is actually running on the merit of the system. So yeah, profit taking for me is a mathematical number, and it is based on the parameters that your own system generates over a period of time. But if you do not have, like say you're a new trader, or you have just say maybe 100 trades data, and the system that you're deploying now is not the same as the data that you generated 100 trades back, and you feel this is a completely different system, different time frame, and that the readings will not be relevant. In such a case, the best information that you have is the chart pattern in front of you, and you can use either the chart pattern, or you could use Fibonacci extensions, or you could use Elliott waves to determine what is a suitable target for you. And so yeah, and what parameter do you use for exit? I think I've answered this question. It is a function of how accurate I want to be in that quarter, in that year. If I'm not concerned about accuracy, and I want speed in my trading, I will obviously start dropping my SLs much lower. I might use 5-day moving averages, 15-day moving averages to simply exit the position. Because I would be seeing a lot of choices in the market, and I need not hold on to a stock for say 50-day moving average or 200-day moving average. I mean, there is no point in suffering with a stock if the market speed is high, right? And how would I know if the market speed is high? The same thing. I mean, if the market ends up getting a DMI setup like this, I would know that the market speed is high. That the market is trading quickly. So logically, I think. Yeah, there are certain so there is a planning that is done before the trade, but usually there is a planning also that is done before the year and the quarter. So prior till 2022, till I had never experienced a significant loss or any loss of that kind in the market, I used to not plan that way. I used to take each trade on its own merit. But after that, I realized that I have, if I just slow down a little bit, or if I just control my impulses to trade a chart which is looking attractive, but rather be more selective about the range of charts that I want to trade. So which means that you would have seen a couple of videos, and there was a question that was asked also in that video, that that said that, sir, you mentioned you don't trade patterns, but in a video 2 years ago you mentioned that you did. And that is my point, that actually it's not like I do not trade patterns. I simply do not see the merit of trading a pattern is going to be formed in a phase of irregular highs and lows, creating a certain pattern. And if the market is creating regular highs and lows, then why would I want to suffer in that particular security? So I would rather wait for the pattern break, or typically I would be much before the pattern is in there only. I wouldn't be in halfway position through the pattern to basically go there, because I would only enter when the security is oversold. It cannot be fully oversold at a midpoint of the pattern. If your ratios are as I have told you, if your ratios are different, then yes, you will get different times in which that happens. But over a period of time, even if you get the ratio wrong, I feel if you're consistent about it, by wrong I mean not the same as me. At the expense of sounding conceited, that is what wrong means for me at this point. But even if you continue to use stochastic 14, for example, it's not like it's going to give you bad trades. It's going to give you reasonably good trades. It is my opinion that it is not consistent with what you're doing. You're shifting by one time frame, so you should typically shift in a ratio of 5. So, but those irregular cycles relative to your own time frames will adjust after 100-150 trades, and you will consistently be entering in a position where someone like me would be seeing it from a distance and wonder, why is this person entering here? And in some cases, when your trade will fail, I would say, yes, see, that was the mistake. And when your trade will succeed, I'll be like, that's quite impressive. Yes, obviously, because stochastic was oversold and things of that sort. So yeah, it will be an off kind of a rhythm, but it's a rhythm basically. Sorry. I'm actually in Leh Ladakh, and it's like about 6 degrees. So I'm sorry about the cough and cold that you have to put up with. Now, for example, you entered ABC trade at 2000. The price went till 2500, started going down. Where will you exit your trade? So this is addressed. Second question is, how would you pyramid your trade? And my question is, why would I pyramid a trade? I would simply look at a trade as a new trade. I bought a stock at 100, and now that stock has trading at, let's say, 300. Obviously, if it was uptrending at 100 and it is creating new highs, it is most likely be uptrending even at 300. Now from 300 it pulls back to, let's say, 220, and at this point it is highly oversold on the weekly, and there is a huge bullish engulfing forming on the daily. So I will re-enter that stock, but I will be looking at it as a new trade. Just that since my method would be same, let us say here I will use the 6 monthly low as the SL, because I want a higher accuracy system. My previous position, which was created at 100, would be trailing it actually. So there is no, so pyramiding is actually a word that is it is a process that is coined to to basically suggest that that over a period of time your maximum capital will get allocated to your most successful stock, and that is what pyramid strategy means. So which means that once you take up a trade position, at what point do you reopen that trade? And this is where I feel partial targets etc come in handy. So once your loss has been covered from the system, you can reopen the trade, which means that the security can come back to your watch list. And if it becomes oversold again, you repeat the same process again. On documents it is what it is called pyramiding, but you're looking at it in isolated trades, and you never know, you might actually hit a jackpot. You might end up in a trade which hits a target every 2-3 months, and every 2-3 months it oversolds on or maybe every 6 months it gets oversold at a particular time frame, and you get an opportunity to buy again. And yeah, and you could ride out a very big wave. And I would like to conclude this video by saying that 90% of your earnings are going to come from 10% of your trades. So make sure your behavior is optimal, which means that when you decide that I will exit on the 6-month low, then stick to it, because that is where your earning is going to come. And that 6-month low would have been the reason why you created X quantity of positions. If you decide your SL is going to be the 6-day low, then stick to that. All right. But whatever it is that you decide, you stick to that in order to ensure that your quantities are consistent, and that the law of large numbers is statistically in your favor. Because if there is a deviation, you will be assessing your own data in order to make improvements. So with that, I hope I have addressed not just Harish's questions, but several questions actually that have been asked, which were led from the conversation that I had with Asim. And yeah, I hope that this video has helped you in some way. I wish you well. Take care.